How do you calculate covered straddle profit? Have you ever wondered how to calculate profit from a covered straddle in options trading? This strategy can be a bit tricky, but understanding it is key to making informed decisions. Let's break it down step by step. A covered straddle involves owning the underlying stock while simultaneously selling both a call option and a put option at the same strike price and expiration date. This approach allows you to collect premiums from both options, generating income. However, it also carries risks, especially if the stock price drops significantly. To start calculating profit, you need to identify a few components. First, know the purchase price of the underlying stock, also known as the cost basis. Next, add up the total premiums you received from selling the call and put options. Finally, consider the stock price at expiration. Now, let's calculate the break-even point. This is where your profit and loss balance out. The break-even point is calculated by taking the stock purchase price and subtracting the total premiums collected. This means the stock price can fall below the purchase price by the amount of premiums received before you start losing money. Next, let's determine profit or loss at expiration based on the stock price relative to the strike price. If the stock price is above the strike price, the call option will be exercised. In this case, your profit is the strike price minus the stock purchase price, plus the total premiums collected. Keep in mind that this profit is limited because you sell the stock at the strike price. If the stock price is exactly at the strike price, both options expire worthless. Your profit in this scenario is simply the total premiums collected. You still own the stock and keep the premiums. Now, if the stock price is below the strike price but above the break-even point, the put option will be exercised. You will have to buy more shares at the strike price. Here, your profit or loss is the stock price at expiration minus the stock purchase price, plus the total premiums collected. However, if the stock price falls below the break-even point, losses can increase. In this case, your loss is the stock purchase price minus the stock price at expiration, minus the total premiums collected. This situation can expose you to significant downside risk. To summarize the profit calculation, if the stock price is greater than or equal to the strike price, you calculate profit as the strike price minus the stock purchase price, plus the premiums collected. If the stock price is between the break-even and the strike price, it's the stock price minus the stock purchase price, plus the premiums collected. If the stock price is less than or equal to the break-even point, it's the stock price minus the stock purchase price, plus the premiums collected, which results in a loss. Keep in mind that the maximum profit is limited to the gain from the stock appreciating to the strike price, plus the premiums collected. While the premiums provide some cushion against losses, they do not fully protect against a falling stock price. This strategy is best for investors expecting minimal stock price movement or slight bullishness. Always remember that risk management is essential, especially since the short put can lead to substantial losses if the stock price drops sharply.